Welcome back to our intermediate financial accounting class. In our last three segments, we've been talking about pension expense and all of the different journal entries and calculations that are part of recording pensions for the period. We walked through the first three steps of calculating pensions for defined benefit pensions. Remember, we're not worried about defined contribution because it's just pension expense and cash done. So we're really worried about defined benefit because we need to get those numbers and have them accurate. Now that we've done the basics, it's time to step it up a little bit and talk about the amortization, the extra steps that sometimes happen if we need them to. And they're a lot of fun. So let's go ahead and jump right into it. Remember, step one is just gathering beginning balances. Step two are the adjustments to pension expense that happen every period. Step three are the adjustments that don't affect the expense but happen almost every period. The next step then, step four, are the amortization adjustments. And these only happen if they're necessary. So we have all the time, most or some of the time, and when necessary. And there are two pieces to this. Part of it is amortizing away prior service costs. Part of it is getting rid of our excessive accumulated OCI amounts. So this prior service cost deals with changes to our contract. And it can make our obligation go up if in the negotiations we promise them more. It can drop if in the negotiations the company wins and gets a concession and it drops what we have to pay to these union workers or these pension beneficiaries because of the negotiation. The rule with the prior service cost, if you have a balance in your prior service cost account, you will amortize it away because it's going to be amortized away over the work life of the employees whose contract has changed. So if I've got employees that have just started with the company, they're going to work for me probably for 30 years, then I've got 30 years of amortization that I'm going to do as they work and earn this change along with the rest of their pension. For the accumulated OCI amounts, well, we'll do that if and only if companies start to take advantage of the opportunity to estimate their returns. So if you remember, I've got this possibility down here where companies take advantage and either show really high estimated returns to drop pension expense, or in really good years, they may show really low expected returns so that their pension expense actually gets bigger and makes their net income look worse. We don't see that kind of manipulation very often, but sometimes politically it's not good to show too much profit. For example, right after the spill in the Gulf Coast, people were really upset that the oil companies were showing these huge profits because people were spending a lot of money buying extra gas at $9 and $10 a gallon, thinking that there's going to be trouble with gas and Katrina and all that other stuff down there raised prices. And so they had these obscene profits and they tried to find ways to increase their expenses so that it didn't look like they were making such great profits. So sometimes we do that as well. Either way, this amortization is going to happen where we see evidence that your numbers are getting too big here. So how do we do that? Well, let's start with the prior service costs, and then we'll talk about the excessive accumulated OCI amounts. So here are some steps to the prior service costs. Step number one is to figure out when all the employees who are affected by the contractual change will be retiring. Step number two is to figure out how many years of service those employees are going to give to our company before they do retire. Step number three, we're going to take that total change. And I said increase in pension costs here, but it really should be increase or decrease. It should just be the total change divided by the total service years remaining. And that will give us a cost per service year for every year they work for us until they retire. And finally, we take the number of employees working in a given year times that cost per service year, and that gives us our annual amortization. Let's take a look at an example that will help us pull all this together. So at the beginning of year three, ROS 1 changed its pension plan as part of a labor negotiation. According to the actuarial firm that ROS 1 uses, the new obligations will increase our obligation $200,000. So that's our increase. At the time of the change, we had 200 employees that are part of our pension plan and that are going to be affected by this renegotiation. Of those, 15 will retire in year three. So they've only got one more year that they're going to work for us. We've got 20 more that will retire in 2 years. We've got 50 that will retire in year 6, 25 in year 8, 60 in year 9, and then 30 in year 11. We want to figure out how much of these new prior service costs they should amortize away in year 3. So let's go through this process step by step so that we have that number. So step one, we need to figure out when our employees will retire. And to do that, I'm going to make a table. Let's see, expected retirement. And then I'm going to get the number of employees. And we have this information already. It was given to us. Now we're just organizing it a little more logically so that we can see it better. Also, it's not often given to us in this nice little series of numbers. Usually you have to sit down with HR and figure out expected retirements and calculate how many people. And we want to get in the habit of doing this step because there's usually a lot more for it than your professor handing you. Here's the numbers. So let's see. By the end of year 3, we have 15 employees that will retire. In year 5, we have 20 more employees that will retire. In year 6, we have 50. In year 8, we have 25. In year 9, there are 60. And finally, in year 11, we have 30 that will retire. And if we add all that up, that's our 200 employees. Now, again, we had that information, but let's get it broken down into a table. It sets us up for what's coming in the future. The next step is to get what we call the service life. So step 2 is to calculate the total remaining service life. And again, I'm going to build a table. We'll do the years here. And then I've broken these down into groups, and we broke them down into groups by when they will retire. We have a year 3 group, a year 5 group, a year 6 group, a year 8 group, a year 9 group, and a year 11 group, and then we'll get a total over here. Let's see, we're in year 3, so we've got year 3, year 4, 5, 6, 7, 8, 9, 10, and 11. Aren't you proud of me? I counted that out. I didn't even have to use a 10 key. I was just doing great. Now that we've got our table set up, is we're going to look at each group and figure out how many employees from that group will be working in every year. So we had 15 employees in this year 3 group. They will work for us during year 3. And then they'll be retired because they're the group retiring in year 3. They won't give us any service in any of these other years. The year 5 group had 20 employees. They'll work for us in year 3, year 4, and then they'll retire in year 5. So we'll get 3 years of service out of each of these 20 employees. Year 6 was one of our bigger groups. There's 50 of them, and they'll retire in year 6. So we've got 4 years that we'll get from each of these employees. Year 8 has 25 employees, and again, they'll work for us all the way through year 8. Year 9 is our biggest group. We've got 60. We'll take that all the way through year 9. And then year 11, our last group, before they retire, they'll work for the whole period. Now, let me just stop right here. If you can think of another mathematical way to do this, you are welcome to. I like to set it up like this because it makes it easy for some of the future steps. That's why I do it like this. But it is entirely up to you how you want to do it. Once you've got it figured out, then the next thing you do is figure out how many employees we will have working for us in each year between now and when the last group retires. So I'm just going to add straight across this column, 15 plus 20, etc., all the way across. I have 200 employees this first year. Well, that makes sense. There were 200 employees that were part of the contract. They're all still working for me until the end of this year, and then the first group retires. So that's what I wanted to see. Let's see, if I keep adding, I have 185 and 185. Then we drop to 165, and then 115, and 115, and then 90, 30, and 30. And if I add these up, I get my total remaining service life. And that comes out to 1,115. And that's step 2, is to figure out how many years of service I'm going to get out of this group of employees. Again, it's not everybody necessarily in my pensions or everybody in this particular pension. It's just the ones that are being affected by this change in negotiations. Once I've got step 2 done, I want to move right on to step 3. And step 3, I want to get my cost per service year. So basically what I'm looking for is the cost for every year of work they're going to give me. And to do that, I'm going to take the change in my benefit obligation and divide by the total remaining service life. So in this case, the change in the obligation was an increase of 200,000. Remaining service life, that's this number. And I'm just going to round this to 2 decimal places. You can go out further, but I'm going to recommend 2, just so we're all on the same page. And that's step 3, is to get to this number right here. My last step, step 4, is to get a total amount amortized each year. And to do that, my amortization per year is to take the total number of employees working each year times this 179.37. And now I'm just going to round to the nearest dollar. 35,874, 33,183. You have that for a couple of years because you have the same number of employees. 29,596. 2628. $5,381 and $5,381. And then I'm going to add this up. And if I add this up, I end up with 199,997. Because I rounded. And I rounded every single period. I rounded both down here to the nearest penny and then up here to the nearest dollar. So it throws things off. The rule is, if you throw things off that way, what you do is you change this last year. So if I change this to 53.84, then I'm good. Comes out to 200,000. So if you round, just be aware, you probably have to make an adjustment in that last year. Or go back, get rid of the rounding and let it flow through. Either way works. What I'd like you to do for our purposes and examples, we're still going to round down here to the nearest penny, up here to the nearest dollar. If you have to tweak it a bit at the end, then you do. Now, a big mistake people make right here is they just get that first year's number and then they're done. They walk away. No, don't do that. Get the whole thing done. If I have all of these numbers, then I'm ready for all of these future years. I've got the numbers ready to go in a table, in Excel. I can get right to them every year. I can just pull the number out that I need, put it in my spreadsheet, and be done. I'm not having to try to recalculate. Also, if I do the whole thing and I get it built in Excel, if people switch when they're going to retire, it's really easy to tweak it and change it. So the best recommendation I can give you is to do the whole table at once so you've got it. Even though we did the whole table, our question for this period was, what's our number for the current year? And here it is. In year 3, when I'm doing my pension worksheet, I will use this number right here. And I will amortize 36,000, give or take, of the 200,000 this year. And as more and more employees retire, I'll amortize less and less and less until they've all retired and are gone. Now we're going to stop there. We've talked about a lot of fun stuff with prior service costs. When we come back, we'll move on to the next set of amortization, which is our corridor smoothing. Fun stuff. We'll see you then. Thanks.